All right, welcome back. This is Jared Passy with lots of pips. On this video segment of our overview, we're looking into money and trade management. So money management and trade management while you're trading foreign currency. How much to trade, how much to risk, when to stay in, when to get out of trades is crucial to learning how to trade foreign currency successfully. So let's take a stab at least a 5-mile view of what's involved. Okay. First of all, money management. You can't just go out and just throw whatever money you want at a trade and make a consistent, income or be able to stay in the game. You need to determine your risk amount, your risk tolerance. There's a whole lesson we have on risk tolerance and how to determine what that should be. For our examples in this video, we'll use 2%. Some people go higher. We usually recommend lower to our coaching clients, 1.5, depending on the strategy, stuff like that. Account balance, we'll just use a nice even number for our example. We got an example earlier with our double bottom trade of these numbers. Here's our little chart that we use. You can plug in this number, and it gives you this number. You tell it how many stop loss pips you need for your trade, and it'll tell you how many lots to trade. And we have an Excel spreadsheet that does that, and it helps you calculate this out for each trade, which is pretty slick. So just to go over this, if you have an account balance of $9,500 and you have determined through careful study that you, on this specific strategy, would like to have a 2%, would like to risk only 2% of your account. Okay, 2% of $9,500 is $190. So that means that on this specific trade, you're willing to risk $190 of your $9,500 on this trade. And when you're going for $190, you should be going for more. When you're willing to risk 190, remember our risk reward ratio we talked about earlier with our double bottom trade. We got to be going for more. At least that's what I teach people. We take that 190 and divide it by how many pips are going to be in our stop loss. So if our stop loss needs to be 30 pips, and then you take that 30 pips, 190 divided by 30 equals 6.3 mini lots. You use those 6.3 mini lots to determine how large of a position size you want to trade. So you're using your position sizing calculator to determine how big of a trade you're going to place so that you don't end up risking more than your risk tolerance amount and you can stay in the game longer. And this is a simple formula here for calculating how big of a trade or how many lots to trade in each trade. Some of the things you have to know, obviously, is your stop loss level. You can't place a trade with any level of money management if you aren't using stop losses or if you don't know in advance before you place a trade how big your stop loss needs to be. So keep that in mind and use this other money management stuff to help you stay in the game. All right, trade management, trade expectations. Trade management is what to do once you're in the trade. A lot different from how to get into a trade. There's a whole different analysis levels depending on how to get into a trade. When you're in a trade, you're actually making those same decisions over and over and over and over again on why you should stay in a trade. Sometimes it becomes easier just to set your profit and set your take profit and stop loss, and then just ignore the trade, leave it alone, and go do something else. Because one thing that happens to many traders is they get into a trade and they sit and watch the trade. And the more you sit and watch a trade, the more likely you are to see some reason that you're going to want to get out or do something or mess up that trade, which messes up your trading plan. And it may fluctuate a little bit, and you may react emotionally and pop out of that trade and miss out on what it was actually going to end up doing. So that's part of trade management. What we can look forward to or what we can use is trading expectations. We need to have, for each one of our trades, we need to know a good idea of what we expect the trade to do. If you don't have any idea what you should expect the trade to do, you shouldn't get into a trade. Okay, once you have an idea of what you expect the trade to do, you need to look up and place your stop losses. Where can I be protected from this trade? You know, try to be behind certain barriers where the market would have to push harder to get to your stop loss. And you want to make sure that your profitability side is larger than your stop loss. Remember our risk reward ratio. Another thing is we can use this trailing stop losses. We can use trailing stop losses to determine, you know, I want the trade to continue to go. I don't know how far it's going to go, but it's going to go at least 100 pips. My expectation, it may go 500. I don't know. So that's the point where you'd use the trailing stop loss and say, okay, once I'm up 50 or 60 pips, I want to lock in those 50 pips and then have the stop loss trail the trade. I want to come back a week from now and maybe be up 600 pips or maybe be knocked out at 250 because the market pulled back. So there's a whole training on trailing stop losses and how they work. Just know that you can put a stop loss that follows your trade a certain position behind the trade's highest profit level. It never backs up. That would be counterproductive. All right. So, and then we have take profit levels. That's saying that you know, you've got your trade right here, and you expect it to get to here. So you can say, all right, I'm going to put a line on my chart right here. If it hits that line, I want it to get me out. You know, no questions asked. Just close the trade, give me that profit, I'm done. That's what I expect it to do. I don't want to sit and watch this thing, or I'm going to bed, whatever. Also, scaling in and out, you can get into a trade, you expect it to get to here, it gets to halfway, and it kind of hovers for a day or two, and you're like, well, I'm going to close half of my trade. So I'm going to get out with half of it, and then I'm going to take the profit on that half, and then leave the other half to ride the rest of the trade out. So you can do that. But the key is to follow your plan. And you can't follow a plan if you don't have a plan. So I hope I don't sound too soapboxy, but you do need to have a plan. You need to have strategy. You need to know what you're doing. This is not for the sporadic trader. Okay, so that's trade management in a nutshell, right? Not in depth on any one of these, but enough to get you an idea. That's why it's called an overview lesson. Get you an idea of what's involved. All right. So that finishes up that section on money management and trade management. We'll be moving on next time. Be sure to watch the next video on planning and psychology, and also journaling. And these are really key elements. So make sure you watch that next video. And thanks and good luck. We'll see you out there.